Hello everybody, welcome back to our channel and thanks for tuning in. As we discussed a month ago, a lot of air would come out of the cryptocurrencies bubble and flow into gold. As you notice, it's already happening and the price of Bitcoin has dropped from 65,000 to 35,000, losing almost half of its value. Not only Bitcoin but all the cryptocurrencies are down, so as a lot of the momentum stocks that performed well last year. There is a rotation going on from speculative assets to value stocks that pay high dividend and defensive assets such as gold and real estate or physical assets. On the week, Bitcoin dropped more than 20% in price, platinum lost nearly 5%, crude oil was negative in price as well, Tesla, Apple, S&P 500 down, but gold and silver were up. Silver was just 0.54% up, and gold was up nearly 2.12% on the week, which is a strong movement considering that almost everything else was down. Gold is up 3 weeks in a row now. This is the 20-week high and gold has been up 12 out of the past 13 days. But we are still in the early stages, and if you do not own gold, it's not too late to buy it. Gold price is above its 50-day moving average for the first time over the past 5 months, which shows a bullish sign and indicates that the consolidation and correction period is over. And now we point to an upside trend. Very interesting, the long-term bond yield rose last week, which normally pushes the price of gold down, but gold has risen along the bond yields, which is very surprising. So it shows the strength of the upside trend in gold prices. Inflation is picking up everywhere, there is no doubt about it. Even the CPI is how the government measures inflation, which is called by Mike Maloney as CPI, is pointing to higher prices and higher inflation. Bank of America announced that it's raising its minimum wage to $25 an hour. So prices of wages are going up, prices of food are going up, gasoline, materials, transportation, you name it. Everything is going up, but the Fed is just sitting there saying that there is no inflation. On the past Federal Reserve meeting minutes, a number of members of the Fed suggest to start thinking to discuss in future meetings to adjust the pace of asset purchases by the Fed. In my opinion, talking about this is just to change the focus of the market that always discussing if the Fed will raise rates or not. So they start talking about the pace of the asset purchases, so the market doesn't focus so much on the rates anymore and start considering other subjects. The fact is the Fed cannot raise rates. If the Federal Reserve could raise rates, they would probably do it right now, but they can't. In fact, the Fed will have to print more dollars and buy more assets in the future, but they obviously cannot say that. The Fed cannot admit that they are in a corner with no escape. The only way the Federal Reserve will be able to raise rates in the future is if the rates are below inflation. So let's say we have inflation of 4% and the Federal Reserve increases the rates to 2%. So they spread between 2% of the rates and 4% of inflation is 2%. So the real rates would still be 2% negative, which keeps pushing the price of gold higher. Gold at the moment sits at spot price gold $1,831. Gold could consolidate at this level for a couple of days, trading sideways, or could spike above 1,900 next week. Either of these two scenarios are possible. I honestly expect gold to break above $1,900 next week, but two scenarios are possible. What I do not expect at the current economic environment is a sell-off in gold and drop in the gold price anytime soon. If you follow this channel, you know that I believe the bigger movement in gold and silver prices will come on the second half of this year. As I mentioned, I believe we'll see a new all-time high in gold prices, which could be anything about $2,100 an ounce. I have mentioned that 2,300 is a possible target and silver to be between $35 to $40 an ounce. I also believe the peak in prices in precious metals will be some points around the years of 2026 and 2027, and I base this analysis on historical data, charts, and the Dow to gold ratio. Did you ever hear about currency wars? Countries are not trying to make their currency stronger, they are trying to make it weaker. This is a race to the bottom. A country with a weaker currency can be more competitive and export more products to the world. So countries are trying to manipulate their currencies down, currency prices down. Gold and silver are the lifeboats when the economic ship is sinking, and things ahead might get a little worse. So I strongly believe we should allocate a bit of gold and silver in our portfolio sooner rather than later. If you don't have precious metals in your portfolio, you still have time to do so. There are times to make money and times to protect your money. We might be entering a period that preserving your wealth will be more important than we think. When the Dow to gold ratio starts to get around 5, then it will be the signal for me to start reducing my holdings in gold and silver to rebalance my portfolio. I will do that because we will be entering a new cycle. However, I do not expect this to happen before 2026. The Dow to gold ratio at the moment is 18.7, so gold will have to do a big catch up on the years ahead to reach this ratio of 5. In other words, there is still time to prepare ourselves and allocate gold and silver to our portfolios. There is no need to rush and don't overdo it. This will complete the video for today. Thanks for watching, stay safe, protect your wealth, take care.